Hello guys, welcome back to another video from me, okay? Today we're gonna talk about how to find the drawn liquidity and how to identify when not to trade, okay? Let's dive into it. How to find the drawn liquidity. We just need the three things, okay? First, we need the market bias. That means, is it bullish, is it bearish, or is it accumulating? We need liquidity. We need imbalances, fair value gaps. And where does liquidity rest? Okay, liquidity is always below swing lows and above swing highs. Okay, so let's dive into example. All right, so now we have the DXY chart here. Okay, what's the market profile? It's bullish, right? Because the market is going up right there. Price came back into this fair value gap or into this fair value gap. Okay. So let's talk about how to find the drawn liquidity. So basically, it's just market knowledge and how to read the market. So basically, in this example, you can see here is sell side liquidity resting, right? Okay. So we have the market profile, it's bullish. We have liquidity right there, okay? And we have an imbalance, for example, okay? So the market profile is bullish, and we can also add either liquidity or imbalance, or both of them are pretty good. So we created here a swing low. Okay, that means a higher low to the left of it and a higher low to the right of it. Then the price ran up higher. Okay, it created this relative equal highs. Can you see that? And note that relative equal highs or lows are more likely to be attacked by the algorithm than just normal highs or normal lows, okay? So we are bullish, so we want to see higher prices, right? What can we see right there? Price swept this sell side liquidity, okay, and respected it. That means it just swept it. Either it will run through liquidity, that means close with the body, sorry, that means close with the body below it, or it will just sweep it like that, and then it shows us that the market wants to go bullish, okay? So after it sweeps this liquidity, the market is reaching for these relative equal highs. First of all, because it's buy side liquidity and it's relative equal highs. And what did I told you? Relative equal highs will be attacked by the algorithm 90% of the time. Okay, so we are bullish. That means we want to see some higher prices, and we got a sell side liquidity sweep. That means we're going up. Where do we go up? To the buy side liquidity. So you can imagine it like ping pong. Okay, you play ping pong, sell side liquidity, buy side liquidity, sell side liquidity, buy side liquidity, sell side liquidity, buy side liquidity. It's also with imbalances, okay? Price is going for example, buy side liquidity, goes into a fair value gap, bounce back, and reach the same buy side liquidity again to run it, okay? To run through it. It's just ping pong, okay? Sell side liquidity, buy side liquidity. Buy side liquidity, sell side liquidity. But it depends on the market profile. If it's bullish, we want to see for example, a sell side liquidity run or a sweep, and then we target this liquidity right there. So in bullish times, we want to see a sweep of this low or of a swing low, okay, in general. And then our target is then, if we are in a discount, we want to buy in a discount. Plus, if we have this confluence that here's a swing low and the price swept this swing low, and the target are these relative equal highs. Okay, because it's buy side liquidity and relative equal highs. So the price is likely to attack those levels. Okay, so we have here sell side liquidity. We swept it. Now the price, we told ourselves it's bullish, okay? We are strongly believing it, it's bullish. So we are gonna target these highs, okay? These highs. Buy side liquidity right here, relative equal highs. See what happens, boom. So price swept it inside a discount and a fair value gap, more confluence. And then our draw liquidity are these highs. Okay, let's dive into the next example. Okay, price was bearish. Price reached here a weekly gap. Okay, perfectly reacted to it. Then showed us normally the market profile is bearish, right? But now the direction has changed. Why? Created the low of the month. Okay, for example. And then the price made a market structure shift. Okay, so it is indicating to us that the market will go bullish. That means our market profile is bullish. Plus, this time we don't have sell-side liquidity, we have an imbalance right there. So we had a market structure shift, price went down into this imbalance to retest it and perfectly respected it. And because we are bullish, our draw on liquidity is this buy-side liquidity. Okay? It's very simple. Okay? It's very simple. We are bullish. Price went up. Left the high right there. And a gap, an imbalance fair value gap. Price tapped into it. And then where's our draw on liquidity? This buy-side liquidity. Very simple. Boom. So I want, you will not learn the draw on liquidity just by watching it, okay? You have to go into, for example, Forex replay and then backtest it by your own. You go into the daily chart, okay? You will figure out the market profile and you will figure out where the price is probably either retesting and then up, or you can figure out, for example, a liquidity sweep, and then you want to mark the draw on liquidity. Okay, that's it. Or you don't even need to have a liquidity sweep or fair value gap retest, just mark out the draw on liquidity. Okay, market profile is bearish, search some draw on liquidity, for example, imbalance or a low, swing low, and target this. That's it. Okay, bullish examples, target some highs or an order block, but don't go into order blocks. I don't recommend it to you, especially if you're not advanced. Okay, as a beginner in draw on liquidity, then you should just target highs or imbalances. Okay, so just imagine we are bearish. Okay, so right there is the buy side liquidity. So you want a sweep of this buy side liquidity. And where's your draw on liquidity then if we are bearish? It's right there or there. That's also swing low. These are relative equal lows. So you can target those or this imbalance. Okay. So your target for the draw on liquidity is imbalance or swing lows or swing highs. Okay. The most important factor in finding the draw on liquidity is the bias. Okay. You have to know where the price is going. Okay. If you know it's bullish, then it's simple to know that the price will reach to this buy side liquidity. Okay. Especially if it showed you some reaction out of a fair value gap or swept a low, for example. Okay. That was it for draw on liquidity. I hope you understood it. Now we are going into how to identify when not to trade. So we have 3 reasons to not trade. Market conditions, for example, accumulating choppy movement. That means the market isn't trending. Okay. That means the market is just going sideways. Okay. You shouldn't trade in these environments. Okay. Plus, the second reason is bad price action. like the price isn't respecting your order flow, for example, some order blocks for value gaps, it isn't respecting liquidity, especially in August or in these months, not in December, I mean August, July, okay? There is some bad price action because the banks are also um another topic, okay? I don't talk about it, but the price action is pretty bad in August and July, okay? It has some deeper reasons, but it's okay, you don't have to know them, okay? Um or FOMC or non-farm payroll days, okay? So here's an example of choppy price action, okay? It's going sideways, long wicks, sideways, do not trade it, okay? X. Don't look at the charts, don't trade it. Wait for better trending, okay? Wait for either a bullish trend or bearish trend, okay? And this environment also, I don't recommend you to trade this. Look at that, okay? That's too choppy, okay? You don't want to be inside the trade in this choppy environment. Yeah, so don't trade accumulation, okay? So I have some fixed news rule, okay? A fixed news rule. So red folder news, if you have red folder news today, 1 hour before and 1 hour after news, you do not trade, or if you are inside a trade, then close it 1 hour before and 1 hour after, okay? So, or if you have FOMC or non-farm payroll, then you either don't trade the whole day, okay, or you don't trade 2 hour before and you don't trade 2 hour after news. Okay. So if you're inside a trade, then close it 2 hour before non-farm payroll or FOMC. Okay. These are my rules. Okay. And if somebody is saying don't trade on news days, no, that's not right, okay, because the news are bringing in the volume, okay, and the volume is very good for your trades. You don't want to have some choppy movements, okay. Wait. So you don't want to have some choppy movements, okay, like here. You want a trending market, like bullish or bearish, okay? And that's where the news are coming in, okay? Brings volume into the markets, okay? But if you have FOMC or non-farm payroll, as I told you 2 hour before these news are coming out, close the trade, and 2 hour after news, don't trade, okay? Don't trade these days, okay? So I wish you good luck and have a nice day, guys. Bye bye.